member of my technical team in the second reinsurance webinar on reinsurance issues and strategies post-pandemic. I am Masood Wahab, and I'm a senior advisor of ASEAN Institute of Insurance and Risk Management, which is organizing this webinar. I retired from Oriental Insurance Company in 2018 after 36 years of service. I joined Oriental Insurance as a director officer in 1981 and retired in January 2018. After I have been teaching. Can I request all the participants to kindly put off your mics, please? I'll request all the participants to kindly switch off your mics, and if possible, switch off your cameras also. And that will save us a lot of bandwidth, and you will have more clarity. So as I was saying, I served in the insurance industry for a long time, and I have been also teaching and in training since '92. And at present, our organization is associated with Jamia Hamdard University, and we are conducting MBA insurance course there. Our institution has been organizing webinars on subjects of special relevance for the insurance industry, for insurance professionals as well as students and teachers of insurance. And this pandemic has, apart from being a lot of creating a lot of problem, and I'll say it's a curse for the humanity. But at the same time, it has given us a lot of opportunities, and one of the opportunities is this online webinars. Since last year, we started with this because it's very easy to hold webinars. Of course, I know a lot of webinars being held, and that must be a, it's difficult to join all the webinars. But nevertheless, for us, it's an opportunity, and we have been organizing webinars on a special subjects, not any subject. Our webinars have been well received and appreciated, giving us the necessary motivation to continue organizing them. And I'm very happy to inform you about the launch of the Insurance Arbitration Certificate course. This is the only of its kind in India. It's a 6 months, 300 hours online course, and its classes will start from 6th of February. I'm happy to welcome the participants of this course in this webinar. They were especially requested to participate in this webinar. I'm very happy to welcome all of them in this webinar. In the second webinar on reinsurance being organized at a crucial time of renewals of reinsurance in the industry, especially India, a select group of insurance and reinsurance experts from India and abroad are joining us, have already joined us as speakers and panelists, beginning with Mr. R. Chandrasekharan, is a former Secretary General, GI Council. Mr. A. Selvaraj is the Director, Bharatri Brokers. Professional qualification, which also includes Fellow of Insurance Institute of India, Associate Member of Institute of Risk Management, London, Associate of Chartered Insurance Institute. His career in India, UK, and Middle East insurance reinsurance markets has enabled him to gain a unique identity among the reinsurance professionals. I welcome him, and I request him to kindly take over.
Thank you, Aha. Thank you, participants, and thank you, the CEOs and my colleagues. This particular seminar has been conceptualized as a strategic seminar, which will trace what has happened in January 2021 renewals, various markets, and what the April 2021 markets should look to from the reinsurance point of view, and what strategies they should do, and what to say, what not to say, how to handle. So it's a very that's why the first week of February, their markets have got some more time to really plan their program. And I have requested two of our AR colleagues. One is Mr. Jishan from London. He will give a brief on his experience of January 21 renewals and his perceptions as to how the reinsurers are shaping up. Sanjay Mukashi will give his perceptions on the renewals which he has seen in Europe and Central Eastern Europe and former Russia. And once we get feedback on how the 2021 renewals have gone, the CEOs, Sanjeev Jha, Ritesh Kumar, Adi, and myself, we will debate on the problems, issues that we face and how that we are going to handle. So the participants, mostly from Africa, Asia, and India, will gain from this because they are all be looking to the renewals in April 2021. So with these few words, I would like to invite Mr. Sanjay Mukashi, the GIC Moscow. Earlier he was in London. Before that he was in GIC of India. He was one of my colleagues, very well affected in the aviation reinsurance market. Sanjay, over to you.
Before Mr. Sanjay starts, I'll also like to give a brief, short introduction of Mr. Sanjay. Just one sec. I'll just take one sec. Mr. Sanjay Mukashi joined GIC as a directorate officer in 1990, and in 2006 was involved in establishing GIC Re's UK branch in London. In 2007, posted as underwriter in the UK branch, handling businesses emanating from Europe, Caribbean islands, Brazil, Argentina, and Mexico. Back at GIC head office, he looked after aviation RI department for a long time. He also headed the department. And then in November 2019, he went to Moscow. And he kind of set up the office there, and he is a general director of GIC Re in Moscow, which is a 100% subsidiary of GIC Re. Frankly speaking, Mr. Sanjay Mukashi, that GIC Re thing in Russian, you will be the only person to spell it out. It will be difficult for me to do it. So, Mr. Sanjay Mukashi, please.
Thank you, Chandrasekharan sir and Masood Saab. I hope I am audible. Am I audible properly?
Yes.
Yes, thank you. Yes. Thank you. Yes, the name of my company is Perestrokovniye. So Perestrokovniye is reinsurance in Russian. So this is a 100% subsidiary, and I will start with a very brief presentation that I have prepared, which will help me to share my experience of 2021 1st Jan renewal, as also the insights and perspective from my point of view. Before I tell you about my experience of 1st January renewals, I'll briefly let you know about the market here. GIC Perestrokovniye, as you can see. I hope you are all able to see my screen right now.
Yes.
Yeah, thank you. Yeah. So on the right-hand corner, you can see the name of my company, GIC Perestrokovniye. It is a 100% subsidiary of GIC Re. We are taking over GIC Re's portfolio in this region. When I say this region, I mean Russia, Russian Federation, and former Soviet Union countries. So we write business in all predominant classes of reinsurance business, general reinsurance business. And our experience, I will summarize briefly about the market. It is not a very big market for someone who is from London or Europe. The market size is not very big here. There are 4 specialist reinsurers in Russia, including ourselves, that is GIC Perestrokovniye. There is one more specialist reinsurance company in the former Soviet Union region. The main players in this region are from Europe and UK, including GIC Re. Some of the names which I can take are SCOR, Hanover Re, Swiss Re, Partner Re, Lloyd's. All of them participate significantly, lead many of the significant programs in this region. The region is again dominated by Willis Tower Watson, Marsh, Aon, who have local presence in this market. Of course, Malakot is also a prominent reinsurance broker who are Russian brokers. The main characteristic of this market is 99% of the reinsurance program are non-proportional programs. Something a reinsurer would like to see, would like to write. And again, the market is also characterized by low cat exposures. There is a vast, large, huge territory with limited number of individual risks that are well spread. So accumulation monitoring is something that is not very complex. So the cat exposed regions are Kazakhstan, Uzbekistan, Caucasus, and some regions in Far East like Sakhalin. The market cycle is not exactly mirrored with international market cycle. It is a bit vague. As my next slide shows, the market has been growing, moderate growth. It has shown. In terms of market size, I would say that the insurance premium is about $14 billion with a reinsurance premium of about just under $2.5 billion. Again, there are top 10 insurers who dominate the market. 83% of the business is written by top 10 insurers. Nothing unusual for other parts also where the market domination is usually by the top 5 or 10 insurers. The market has undergone quite a significant change in terms of number of insurers. 10 years ago, we had more than 700 insurers. Now, as on date, we have less than 155 insurers. The loss ratios are good. The market is very traditional, so to say. Coming specifically to 1st Jan renewal, what my company experienced that rate improvements continued, buoyed by COVID probably. The increases were particularly higher in facultative segment, not very high in treaty segment as compared to facultative. When I say facultative, I'm looking at the renewals that were in the last quarter of 2020. When I talk about treaty, I'm focused on 1st January treaty renewals. We did not see any capacity issues. All the major programs were placed reasonably comfortably. I saw that major players were insisting on rating requirements, whereas non-major players were little flexible. They accommodated less rated securities as well. In my last brief talk in December, in the first part of this webinar, I had said that the rating agencies had categorized outlook for reinsurance market for 2020 as negative. And what I see in early 2020 as the rating agencies, some of them have revised the outlook for reinsurance sector to stable. So there were no major changes in the way the programs were negotiated or placed. The only significant difference was there were no road shows, no personal meetings. Everything happened online, which is again what we have experienced in the second half of whole of 2020, and I expect the same to continue for some more time. I would still say that we are during the pandemic. Pandemic is far from over, especially in European countries, Latin America, UK. So this is about our experience, my company's experience about 2021. What do I expect for 2021 rest of the renewal seasons in April or July is I would expect the rate growth to continue. If your program is not sizable, if it is not complex, then I would say that placing it will not be a big issue. You can you can place it comfortably. And I would expect that the reinsurance GWP to increase by 5% to 10%. The main drivers for growth will be motor, accident, and voluntary health insurance. So, to conclude, I would say that the reinsurance in the reinsurance market for sellers like us, it was not as great as we expected. Yes, there were rate increases, and there will be rate increases, which will continue for rest of the year. For buyers, the 2022 as bad as they would have expected, say in the last quarter of 2020. So, but with a word of caution, I would say that please start your negotiations early. Data quality should be better, because you will be speaking to your reinsurers online, over phone, and by way of emails. And better not to experiment too much at this point in time. So that's all from me for now. I'm very much conscious about the time frame. Over to Zishan.
Thank you, Sanjay sir. It was really good learning about your experiences in the Russian market.
Zishan, if you permit.
Go ahead, sir.
We'll just take it. I'd like to introduce Mr. Zishan, one of the youngest speakers here. He's a senior reinsurance officer in Afro-Asian Insurance Services. It's a brokering company in London. He operates from London. He was initially with GIC Re. He joined there as a direct recruit officer. He's a product of National Insurance Academy, Pune. And after serving in GIC initially, he was posted in South Africa branch of Cape Town of GIC Re. Then he came back to GIC Re head office. And after being there for some time, he quit GIC Re, and now he's joined this Afro-Asian Insurance Service broker in London. And at present, he's operating in London, and basically for the African and Middle East markets. He may be having a very short experience compared to other people, but then he has got a sharp mind, and I'm sure he has learned a lot, which he will be definitely sharing with us. Yeah, Mr. Zishan, please. Mr. Zishan.
Thank you, sir. I will just try and share my screen. Is my presentation visible?
Not yet.
Yeah, it is to me.
Yes, Zishan. Go ahead.
Okay, please.
Thank you. Thank you very much, sir. Good morning, good afternoon, good evening, all the participants. I don't know how many people have joined and from which time zones across the globe. So that's why I had to say good morning, afternoon, and evening. It was really good learning from Mr. Sanjay Mokashi about his experiences in the Russian market. And basically, he shared his experiences at 1-1, and I would say that it's not far from what we have experienced in the African market. Before I go ahead, Mr. Masood Wahab has already introduced me. I work for Afro-Asian. We are based in London, a reinsurance broking company, but we are a very unique broker in the sense, although we are located in London, our 100% business is in Africa, and we take pride in marketing ourselves as African specialist broker. And me personally, I have been dealing with African markets for the last 7 years approximately, earlier with the GIC South Africa Limited, and after that with Afro-Asian Insurance Services. So my talk today would only be centered around what has happened in the African reinsurance and insurance market. And I'm sure Russian market and African market together, these experiences would help the Indian subcontinent markets to prepare well for what is going to come at 1/4. We are not very big in South Africa, so we do not really have great experience in the reinsurance market of South Africa, and it's a completely different market. So I'm not sure whether we can generalize, and that's the reason I have tried to keep it Africa, excluding South Africa. Before we get into the key trends at 1/1, it's important to know a little bit about the African market, because I'm sure there would be participants who have never dealt with Africa, or they have very limited knowledge of African market. In a nutshell, Africa, when we say it's a continent, it's not a country. It is composed of around 50 countries, and each country is a different market in itself. We can always generalize some regions like East Africa or West Africa, but in terms of operational levels of each country, they are all different. In general, the countries or the economies in Africa are smaller compared to other parts of the world, but some of them are growing steadily at 5% or plus, like Ethiopia or Rwanda. We have seen a great deal of volatility in terms of interest rates across the countries. Currency exchange rate is an issue for many countries, and we have seen countries like Nigeria or Zambia, Zimbabwe, and to some extent Ethiopia. Exchange rate has varied greatly, and these currency exchange rates are very much sensitive to any international event that has an effect on the economy. Similarly, inflationary trends are also varying across these markets. Insurance sector is also very, very different, although there are some similarities when we say one particular region like East Africa. Rates have remained very, very competitive over the last few years, and that has actually put more pressure on some of the reinsurers in terms of their return on capital. So this pandemic, this event that has happened has really paved the way forward for the change that reinsurers have been craving for last many years to bring back a cycle which is slightly harder, wherein the rates firm up and reinsurers have better opportunities to make good margins. In terms of how reinsurance is bought or placed, it's difficult to generalize, because, as I said, there are several countries. But if we have to draw something which is common, then we can always say that the typical treaty reinsurance program is usually a bouquet, wherein the buyers, the insurance companies, they buy proportional and non-proportional treaties for several classes together. They negotiate all the programs together. We have also seen a huge retrocession capacity is required, and when I say capacity, I mean proportional capacity in terms of quota shares or surpluses. Facultative, there is limited expertise for very specialty classes like oil and energy, aviation, liability, D&Os. So there is good reliance on international reputed underwriters and markets like Lloyd's, London, and elsewhere in the international arena. CAT activity has not been, too much in the region except South Africa, and that's the reason we have seen that the amount of CAT cover bought by the insurance companies or reinsurance companies in Africa is very, very low. And then there is a heavy reliance on retrocession because several countries, and each country has at least one reinsurer, I would say, and I would be fair in saying that. But most of them have very limited capacity, so they rely heavily on the retrocession capacity. And then when we talk about retrocession capacity, a part of that capacity is available locally or regionally in the continent, but a major part of that capacity comes from the international market. So which tells us the link between the African direct market, the reinsurance market, and the retrocession market. So anything happening in the international market, any hardening of rates or any major event that has an effect on the international market, certainly that event trickles down and leaves some impact on the normal reinsurance purchase in Africa too. Moving on, current state of the sector. 11 months into the pandemic, we have tried to understand the African story of COVID-19 from the socio-economic impact. Obviously, economy-wise, most countries have suffered, and more so in Africa, because some of the countries had a major reliance on the tourism industry. So tourism industry is the one, and when I say tourism, it also includes hospitality. So that is one of the worst affected industries. So obviously there is an impact in terms of it translating into the insurance premiums, and people having the affordability to buy the right cover or right amount of cover. Insurance claims, obviously, we have seen some improvements or some major improvements, especially in the motor sector, as it would have happened elsewhere in the world. Loss ratios have really improved. It has also improved in other classes of business. We haven't seen a major loss in the whole region that we operate last year. And then that gives us a way to discuss, was there any paradigm shift in the insurance business? I think it would be too early to say if something has really shifted in the insurance business, but obviously there are pointers that tells us the real story of how insurance is usually bought by the clients. For example, insurance is still not seen as a as a necessity, but rather bought as something that gives you comfort. So we have seen the commercial businesses who have suffered because of this lockdown. Most of them, they are hesitating to buy right amount of cover. They are trying to buy limited cover just to maintain the continuity, not understanding that the insurance or an event is something that can happen anytime and lead to a major claim. But that again tells us about the affordability, whether they can afford such a cover. Moving on to treaty renewal seasons, we have really experienced signs of hard market conditions, and we had been getting signals right from July or August that this year the market is going to be tough, and we had been trying to sensitize our clients that you need to be prepared well in it. And one of the advices that we gave was about starting early this year, because as you get towards the second or third week of December, it becomes really, really difficult to negotiate a good price from the reinsurers. So, and much in the line of expectation that we've seen some clients who had started early, say in mid-October or late October, and they tried to negotiate by mid-November. They have got really good deals on their insurances, meaning their prices or their terms that they have gotten are much better than the other clients who had delayed the negotiation process into the mid of December or late December. There has been some capacity retraction. As I mentioned, we have seen some reinsurers or international reinsurers who were generally giving good retrocession capacity to various regional reinsurers in Africa. They have tried to retract their capacity in the name of accumulation, or they were trying to put in some extra restrictions on the coverage in terms of what is covered, what is not covered, which territories are covered, or how much is the capacity. And that has led to very, very tough negotiations. So again, that tells us that reinsurers are really wary of their return on capital. They're trying to put some restriction on the accumulation control, just to avoid spirals, etc. Terms were tighter, and then some of the covers were very, very expensive. Even those programs who were running clean or running at very, very acceptable loss ratios, we have seen there is uniform increase of 5 to 10% across all treaties, with some exceptions, of course. International retrocession trends have really trickled down to the bottom, and as many regional reinsurers who otherwise reinsure local companies, they find their retrocessions becoming expensive. So the effect is that they have trickled down those prices back onto their cedents and trying to impose some conditions that will try to bring in a better underwriting discipline and firm up the rates at the original insured level. So if we sum up and find out what are the events that are shaping the current reinsurance market in Africa, obviously socioeconomic impact of COVID-19 is the first one. We have also seen some effect of man-made catastrophes like the Beirut explosion, because some of the reinsurers operating in the North African region, they had heavy exposures in the Middle East, including Lebanon. And the effect is that they have posted huge losses because of this Beirut explosion. resulting in either change of the complete structure of their insurance program just to keep the price under control, or the price has gone up in a significant way. The effect of we have seen that the alternative markets putting in capital into the reinsurance sector, they had been on the rise for the last few years, but this year they have either come down or flattened, and that has a result on the overall capacity available from the conventional markets, and that has led to some hardening of the market. And of course, some uncertainty and the verdict-like business interruption claim in the UK. So that has pushed up the cost of capital for some international reinsurers who had some interest in Africa. So overall, it has all resulted into a hard market condition in a limited way, but there is momentum, and we all expect that the momentum is going to continue for at least 2 more years. So pre-pandemic era, I think I've already spoken most of this slide in my previous slide, that the market was very, very soft, rates were low. There were proportional retrocession capacities, generally imbalanced, low income, bigger capacity, because there were reinsurers willing to put in capacity. And that had led to huge competition. And then some regional reinsurers of Africa, they were writing business beyond Africa. So which means their retrocession programs were becoming very hard retros. And even those hard retros were covered by multiple retrocessionaires across the globe in advanced markets and also in local African markets. So local reinsurers writing everywhere, and then a lot of reciprocals between them, and everyone is buying retrocession from the same international reinsurer, similar set of international reinsurers. Was it leading to some kind of a spiral risk? This is a question that we all need to think and answer. As a broker, I'm not in a position to answer that question. And then the requirement of A-rated securities, always there because of regulatory directives in some of the territories, or because of internal risk management policies. It was limited. It was not like all companies, they want all securities to be A-rated, but it was there, and it was working in the interest of Africa to an extent. Pandemic era.
Mr. Zishan, I mean, we'd like to come back to you. If you can conclude so that we can.
Yeah, I think I'm on the last part of it. Maybe I will take maybe 2-3 minutes more.
Yeah, please.
So finally, just trying to tell you the key trends that we have noticed at 1/1 treaty renewals and also some of the facultative renewals, that there is an impact from the international retrocession to the local reinsurers and then to the direct insured. We have seen this impact in some of the markets like Kenya, which is one of the major markets in Sub-Sahara, that local reinsurers who otherwise reinsure local companies, they have tightened their underwriting. They have put in minimum rates criteria. They have revised the table of retentions, what capacity would be given, what balance will be maintained. So all those things in order to bring in underwriting discipline. The only question is the timing right? Because of 2 or 3 reasons. And one of the important reasons is the direct insured or the original insured who's buying insurance. At this time, he is facing challenges of cash flow because there is no business. Are they really going to afford covers wherein they are going to pay higher price than they were paying in the earlier years? Secondly, there is a cash flow problem. Some of the regulators in Africa, they have said that no insurers should delay any COVID-related claim. At the same time, they say that the insurance companies shouldn't be too tough on collecting premiums from the insured, the covers they are giving. And then the reinsurers are saying that no more 60 days, 90 days PPW must be paid within 30 days of the cover is cancelled. So is it all gelling up well and leading to a sustainable growth? There have been some demands from new lines of businesses like D&O, cyber, which is quite obvious in the current scenario. So what is the likely outcome in the post-pandemic era? And are we really going to see these changes happening in Africa being resonated in the Indian subcontinent market at 1/4? I certainly believe that a good part of it will certainly be seen in the Indian subcontinent renewables. And as Sanjay sir has advised, my advice is similar, that most companies should start doing it. In the longer run, and in the weaker economies, we will certainly see some consolidation in the markets because of increasing cost of capital. And then with reinsurers making these positive changes, we will see some good underwriting discipline that will create a sustainable reinsurance buying strategy over a long term. Finally, some of the companies who have been relying on reinsurance, but also putting in their own capital for some high risk businesses, we will see that they will change their insurance buying strategy, at least for the purposes of solvency, or for the purposes of taking capital from those classes which are higher risk, like mining or aviation, and trying to get capacity from the international market. This is all from my end. Thank you very much.
Thank you, Zishan. Thank you very much for giving an excellent presentation. I know you had a lot of things to say, but then due to the time constraint, we will be now going into the roundtable with the CEOs, and for that I'll request Mr. Chandrasekharan to kindly take over. Sir, Mr. Chandrasekharan.
Thank you. Without wasting much of the time, since we now have the flavor of what has happened in January renewals in some of the markets which are near us, like Africa, Russia, etc., I find a lot of similarities in the markets that we have compared vis-a-vis the market like India, which is going to go for renewal in 2021 April. The size may look different, but the characteristics and the behavior of the insurers and reinsurers are by and large same. So I'm coming to the panel. Thanks for Mr. Rakesh. Thanks for Hadi and Sanjeev which have joined us. And Sanjeev has already done his renewal in January, and therefore he is going to talk from a person who has already gone through the problem, and it has come out very unhurt or hurt. We got to hear from him. I would pose a question to all the three panelists to look at what do you think that happened in January 2021 renewal from a reinsurer mindset, from an insurer mindset, that you can mirror in the forthcoming renewals. How do you see the cedents have reacted? How do you see the reinsurers have reacted, whether it is in Africa, Middle East, or Russia, Europe? Which you think would you be seeing a similar reaction in the forthcoming January renewals? So I would request Ritesh to go first.
Thanks, Chandra, and thank you for inviting me to this conference. See, I mean, at a larger level, I think, from what I've heard from the two sort of presentations and what one has generally heard in the marketplace is that largely what we have seen is that the renewals have happened on the merits of the programs. Okay, now obviously there has been a cautious stance for the market. Given sort of what's happened on the COVID. But obviously the COVID effect has not been uniform across geographies, across lines of business, across sort of companies. More specifically, we were to talk in terms of India. And, we are a market participant across lines of business. What one has essentially seen is that other than the health line of business, the impact of COVID has been minimal on the other lines of business. Not only that, when I, for instance, look at the property business, which again, from a reinsurance perspective, becomes one of the key lines, per se. What one has very, very clearly seen is that, given 2 years of hardening of the rates, which have been there, we are now almost in a situation of what we were pre-2008, from a property perspective. And we've actually not seen any, most of our treaties per se, or the policies don't have a non-material damage PI. sort of in the marketplace, and therefore they have not been impacted by the entire COVID. I mean, this is really something that one sees should sort of help the Indian market sort of on April 1. I mean, you would recollect that, I mean, in April 20 itself, we did get some two sort of very, very key sort of exclusions in the treaties. One was the pandemic exclusion, since ours is April 1. So the pandemic had already broken. And the cyber exclusion. So these two, in any case, we've seen happening in the marketplace as on April 1 last year. So to that extent, one does not even see too many sort of changes happening. Of course, the reinsurers on this panel, I mean, should be the one that we should be looking forward to hearing. Because what you hear from me is also a cedent's expectation, perhaps.
Yeah. Before we go to reinsurer, can we ask Sanjeev to spell out his troubles and tribulations which he went through?
Fantastic, Chandra. I wish this was a physical meet. I would have gone to the bar with you and had shared all my troubles and tribulations. I think it's an interesting time we are in, because while pandemic is obviously the something that is very immediately hanging around us, I think the fact is that the reinsurers have been going through a tough time for the last 2 years. I think there's been an issue of climate change, weather losses. GIC itself has gone through some tough times in terms of managing its own P&L. What the pandemic did really was take away the entire magic from the investment income, at least for 6-7 months of last year, and that had a dramatic impact on the P&L and the balance sheet of many of the global reinsurers. And I think that was the reason why many of these guys got downrated. So there was historical losses of the reinsurers carrying it. There was a down rating that happened in 2020, and then there was this entire uncalculated, like really a vague amount of loss that was sitting with reinsurers, because there was a fair amount of ambiguity which remains in many markets in how do you deal with certain pandemic-related losses where the policy terms haven't been clear. So most of the reinsurers and many of the cedents are sitting with significant amount of reserves for what is potentially could be a COVID loss. Now, the good thing, and I sort of echo what Sanjay said, is that I believe that in 2021, we'll see many of these reserves getting rolled back. I think we'll see many of the investment income, the negative impact that the reinsurers had, getting neutralized. Of course, the weather loss will remain, and that is something that we are exposed to, especially a country like Sri Lanka is extremely exposed to. So I see the supply from a cedent's perspective. I see the supply of capacity getting better. There are some things that echoed what between Sanjay and Zishan mentioned, and I'll echo that with my own experience of December of 1st January renewals. One is getting A-rated security is difficult. GIC is the big boy in our region, and when GIC got downrated, I think we all were shaken up. And a country like Sri Lanka, though it's a small operation, it is very sophisticated because it is a risk-based solvency environment in Sri Lanka. We don't have things like premium before cover. So rating becomes very important for us in terms of managing our own our own capital adequacy. So there is a shrinkage of capacity on the A-rated paper, primarily because GIC is not there now anymore. There's no problem of capacity, but there is a shrinkage of A-rated paper. And for markets which are on risk-based capital solvency, that becomes an important influence. I echo the fact that on proportional treaty, there has been really no major changes in terms and rates. Again, some reinsurers have changed. Lastly, the change in terms that we've seen, and this is something that Ritesh also mentioned, we've seen in Sri Lanka is the increase in rates on the non-proportional, especially the event-based XOL treaties. Now, Sri Lanka has been exposed to flood losses. Every 2 years, the island gets flooded and there are major losses. So the rates have been climbing on the non-proportional treaty, and we've seen that again in 2021. But on the treaty side, we really haven't seen major changes, little bit of tweaks on commission, largely reflecting the cedent's own underwriting results. I absolutely echo Sanjay and Zishan's advice that start early. I think there are two reasons for it. One is I think many of the reinsurers themselves aren't very sure of how they look at different markets or different risks. They're also learning. They're learning as much as we are learning. So there's a bit of uncertainty. Secondly, the point that Sanjay mentioned is that interaction with reinsurance is a bit clumsy this year because we are dealing over phone, we are dealing through Zoom calls and MS Team. Like, we're not dealing over a cup of tea or something. So it makes the entire interaction that much more difficult. And I would really recommend that start as early as possible. I think Zishan made a point that he's seen in his own experience. People who started in October, November had a benefit. They could sue up a treaty capacity, and that's something that we've also seen from our own side. And specifically, I see like Indian market has had the benefit of the pandemic exclusions coming in last year itself, so that won't really impact them this year. For us, it was a new thing because we are the 1st January, so for us it came for the first time. Now, obviously, there's an issue in terms of explaining to the customer and the direct insured, but that's something we are all grappling with. So net, Chandra, I think 3 or 4 points that I'll echo. A-rated security is more difficult to get, mainly because not that it's not there, but it's basically we have been so reliant on GIC throughout that their down rating has really made us look in other markets. Rates on non-proportional has gone up for us, again, because that reflects maybe the Sri Lankan nature of the market. And third, I would say, like, really start early, start as early as possible, because data is tough. It is difficult to engage and negotiate as of now. And you may end up exploring different routes because your traditional suppliers may not be able to provide you what you've had as expiry.
That's pretty much the experience in January, which echoed by a practitioner and a person who's actually gone through the renewal. Hari, I'm coming to you. Now, can you pick up the points from the reinsurance perspective and speak your mind, speak your views?
Yeah, thank you. And yeah, great to be here. And thank you for the very good presentations, I'd say, made by our speakers at the onset. And I think some really good points that Ritesh and Sanjeev made that I'd like to build on a little bit and give some context. So when we look at a renewal period, so whether it's 1/1 or 1/4, it's really a reflection of the experience and a little bit of what has happened in the prior year, and as well as what we anticipate for the future years. And so, looking back, I think globally, the reinsurance industry has been experiencing challenged underwriting results on the back of elevated, natural catastrophe losses, which Sanjeev just mentioned. And as well, for the more global players, some adverse development for casualty lines for prior year business. And so you put these in perspective, and then you start 2020, and then we have an extremely unexpected event, which is COVID-19, which drives a significant, I'd say, an economic and health crisis. Overall, it wasn't just a health crisis. I think it impacted all aspects of the economy, including, of course, our businesses. And so you start to see, more pressure on interest rates during the year. And I think that was already an important topic in 2019. Obviously, the downward pressure on interest rates continued throughout 2020. I think, it's probably here to stay, at least for the foreseeable future. And so that makes it, particularly for P&C lines of business, if we're talking in the context of P&C lines, especially for long tail lines of business, it makes it really challenging for these lines of business. And so, I think you put these together, and this is, I would say, the implication of these factors. So the looking back on the challenging underwriting result, the interest rate, the COVID losses, I think that's for our industry overall. I don't think it's the reinsurance industry that has only suffered. And clearly we can see that across the markets, right? So it's felt, by insurers and reinsurers alike. And so really, what I heard from our speakers in their presentations when, on the reflections on 1st Jan is a lot, improvements in terms that came across a few times, increased rates. It was measured, and I don't expect that, I think I've seen numbers ranging from 5 to 15% in the presentations. Of course, that would not have been for each and every single insurer. That's, an overall rate increase. So there's still the understanding that, yeah, we need to, to be present in our markets and understand how the market reacts. But that's where it should go. I think we should, have, I'd say, and that's already happening. You're more disciplined on the writing, more clarity on the covers, clarity on exclusionary wording, so that we're not in a position where we're confused and clients are confused, and insured basically are confused as to what's covered and what's not. And I think in the context of our market for India, right? I mean, we don't live in isolation of the rest of the world. We are part of a global economy and a global industry. And so I think there has also been manifestation throughout this years that shows that there's need for more discipline in underwriting, and maybe we need to tighten a few things. And that emerged throughout the 2020. And so I think there's expectation for us to see that trend continue. But like I said, directionally we look at this from an overall portfolio or market perspective, right? So what improvements need to be done, and I think it has to be a joint effort between reinsurers and insurers to achieve a positive and good result for the upcoming renewal.
Yeah. Now a very specific question to all the three. Do you think I would rather say excuse or the argument that the UK decision on BI claim, the UK court, or in particular the pandemic issues, will be a bargaining point in the coming negotiations for renewal from the ceding company's point of view or from the reinsurer's perspective? Very specifically, do you think the pandemic result is insurable or not insurable? Whether the developments in UK or the so-called impact of pandemic on the products, on the exposure, on the ability to purchase, on the ability the GMPI will go down, the GWP will go down because people may not be buying adequate cover, etc. How do you think this pandemic-related issues will be used as a bargaining tool or an argument to impose higher prices? Ultimately, post-pandemic, are we going to use pandemic or the vaccine or the court decision? You just have a 360-degree of what the pandemic is representing to you as an insurer and a reinsurer, and please react. Yes, Ritesh.
See, again, I mean, as a company, we cannot be oblivious of what is going on in the larger ecosystem. So that is something which is well understood and appreciated. The fact remains that a lot of the things which are happening at a local level always has a much larger role to play. When it comes to a reinsurance program, I've seen years wherein if the Indian market they had high losses, but globally reinsurers were making money, they would come in and be nice to us. Okay, so and then that's the reality, and then and I'm just sort of speaking without any offenses to anyone. So at a larger level, the results of the marketplace really need to speak. And really need to be the yardstick when sort of something specific is happening in the marketplace. Okay, so the Indian context, Chandra, we will have to remember this year is extremely different. While we had COVID the whole impact of COVID was felt from beginning of the last calendar year. But let's not forget that we implemented a rate increase in that time period. We did not go out and say that because it is COVID and life should be as usual, we will not go out and implement it. And then there was this, We all know that between the calendar 2019 and the calendar 2020, there have been two very, very significant doses of rate increases that we've seen on the primary side. Okay, and and this is very, very clearly now reflecting in the results of the treaties. All I can tell you is that you would have loved to wear your reinsurer's hat now. When you would see some of these performances. As a cedent, it is a very, very clear expectation that this is something which will reflect. At the same time, there were mentions in terms of the ratings, and Sanjeev specifically mentioned that today getting a A-rated reinsurer has become difficult. See, from an Indian insurer's perspective, GIC to us is a national re. Okay, and there are sort of local regulations basis which we need to, in any case, within the country. But I think this by itself has become a very, very important aspect, that given what is happening as a consequence of the COVID the world over, today it is very, very difficult to judge the financial strength of some of the reinsurers in the overseas market. Basis what has happened in terms of, did they have event insurance exposures? Did they have some other exposures per se? So at a larger level, the Indian insurers will need to be very, very careful in terms of who they go out and reinsure with. We are to that extent blessed in a manner of speaking that today when I look at the Indian market, we have GIC, which is there. We have all the FRBs. And then we have some of the world's sort of top reinsurers who are present in the marketplace as sort of foreign reinsurance branches. So our context slightly to that extent is better, because all these FRBs obviously understand the marketplace much better, and are represented by local people here largely. They understand the context. But I think rating is going to become sort of even a more important aspect now. Because fair enough, Indian risks are not really a long tail risks. But having said that, one would need to be sort of careful on that aspect. But the fact is that yes, there could be some rub-off of what's happening internationally, but we cannot forget, and we should not forget what the local context is. The marketplace is large enough to go out and define what happens in the marketplace. It's a 2 lakh crore market. And let's not ignore that.
Yeah, just one quick comment on the rating downgrade clause. Rating downgrade clause, in my view, be carefully gone into to see that it is not one-sided. If at all with the rating conditions, they impose a rating downgrade clause once again, for us to make sure that it is two-sided. That's the only point I wanted to make. Can I go to Hari?
Yeah, thanks, Chandra. And I think so Ritesh makes some good points in his perspective on the upcoming news, and as well expectation. I hear that these are as well market expectations. So I think, like I said, it's fair. There's some echo when I speak. Maybe. Thanks, Ritesh. And so I think as I've just mentioned, we have to put and Ritesh, you rightly said it. So we have to put the global context into place, but that should not be the only context that we look at, right? There's a reason why we are we've been associated with Info for many years. I think most of the FRBs have a very good understanding of the market, and actually have been very supportive of the strengthening of rate that took place over the past 2 to 3 years. And I think that somehow I think across cedents the picture varies though. So across the market the picture varies. Whilst overall, yes, it's positive again, but across the market the picture varies. And so there's a need for us to reflect that varied picture, is what I would say. Putting the global context, or going back, Chandra, to your original question on the global context, and what does the UK, BI claims mean? I think, there's one thing it says, there's a lot of uncertainty. So I think that's clear. So there's need for us to bring certainty, and hence the need for us to have, good exclusionary wording where, we are not in positions where, neither client nor insurer nor reinsurer, are clear on what is covered and what is not covered. And so, that will probably carry into the coming year. It's hard to say at this point, what it will look like in terms of, manifestations on the long term, right, for a non-damage BI. The good thing, for Asia, if I put Asia in context, right, so that's sometimes the silver linings of pandemics, right? So this is in the context of Asia, it's not the first pandemic that the region has experienced, and that has, and that's one of the reasons why, we're having less issues with exclusionary wording. That's because, these have been already in some parts of Asia, and, for regional players or local players have already been embedded learning from, previous pandemics that spread over, the recent decades in the region. So I think in the context of our market, we've made the point already. So there's I think a good foundation for the clarity on wording, and it's important that this continues. Yeah. I don't know if Sanjeev would like to,
I think I echo both Ritesh and Hadi, but just as a perspective, Chandra, we got to remember that our industry is the modern avatar of our insurance industry is nearly about 400 years old. And we started with the great London fire in 1666 or something. Now, we as an industry, we've gone through many fires, many floods, many pandemics, and we have overcome, we have found solutions. So I think if you look up slightly ahead, I think you realize that we will overcome as an industry. Now, the issue that Hadi mentioned, and I really agree with that, is about contract certainty. I think what this event has shown is that there are certain gray areas in the way we have underwritten. Forget the reinsurers. I think the way we have underwritten has created a certain gray area. And what is the gray area? The main thing that is being discussed is this entire denial of access to a property and that triggering of a BI. And denial coming in, and those are coming in, the confusion is coming in policies, which are basically have been property all risk, without any specific exclusion on communicable disease or on pandemic. So wherever there has been a vague wording by the underwriters, that has become exposed. So I think ultimately underwriters, and I've seen that on 1st January, while the reinsurers take a view on a market and they have a background of their own P&L impacts, but they will differentiate between a good underwriting company and a not so good one. So if they see the clauses, if they ask and they say, okay, do you have these exclusions? Do you have like, for example, do you have force majeure covers? Now, as soon as if they hear you say, yes, you have that, they'll get worried. But if they see the tight underwriting, I think that's going to happen. And again, the point I'm making, Chandra, is that what Hadi is clear that given the current status or the lack of full knowledge that we have in terms of how to underwrite, exclusions have become important to manage it. But I'm confident that over the next 12 months, 18 months, 24 months, we will find a way of underwriting these risks also. I'll give you an example, Chandra. Like recently, the immediate post the pandemic, we all excluded the travel, the pandemic impact on travel insurance. And we were trying to search for capacity from the international market. March, April, May, June, we did not find that capacity. But come August, September, October, capacity has started coming in. So the underwriters, the reinsurance underwriters who are experts on this have been able to now quantify the risk and therefore give a pricing to it. So I'm confident that the current exclusions we have is there to give us time to really quantify, understand, and then design a cover that will happen in the next 12 to 24 months.
The last question is which you can look at it. The alternative ways of reinsuring, alternative capital, the different capital, that will always fly out of the insurance market now. And therefore, the traditional players will have a better control and they will start demanding better rates, better conditions, etc. So, final advice from you people to the people who are going to renew in 1st April. Final piece of advice as to how would they should approach? Should they amend the program? Should they reduce their cover? Should they continue with the existing reinsurer? Should they try to increase their retention more? What do you think? The final advice from you to the people who are going to renew. So I'm starting again with Ritesh. The final piece of advice.
No, I think 2-3 things. As I said, please be careful on the financial strength of the reinsurer. I think that's something which is very, very important. I've always found that being consistent with your reinsurer helps. So if you have been with a reinsurer, stay with the reinsurer. Don't change the reinsurer. Over a longer period of time, they have basically sort of understood that. Maximize your reinsurance within the Indian market. Between GIC and the FRBs, we've got very, very sizable, significant sort of capacities which are there. I think as Sanjeev and and Sanjay and Jishan said, start early. If you have not started by now, there is a problem.
Yes.
This would really be there. And the other thing is that which is more in terms of an expectation, that insurers do not brush sort of the international experience on India. One and two, I think it's also very, very important. One way that we've always been blessed is that we've had a strong national insurer. When Jishan was making his presentation, the only thought which was coming in my mind was that none of these countries have a strong sort of national insurer.
Thank you. That's funny. Final piece of advice to the leaders.
Yeah, I think, so some good points have been mentioned. From my side, and these are the conversations we have with our partners in India, but, really globally. I think reinsurance should be a strategic buy. And so, we're here to support and work in partnership. We're committed to long-term partnerships, in India and elsewhere. That's how we approach all of our relationships. And so we're here to as well support and enable growth within the sector and the industry. And so, if you look at what happened this year, I think there are a few things that would emerge in the future that we could partner with our clients on, and we're having quite a few discussions on these. And so there are already trends and needs for more, I guess, new and different offerings. We've ran a few consumer surveys throughout this year, and we saw quite a change in consumer and in the insured's behavior and willingness to either transact business online, buy insurance online, by increase their spend on protection products like health, like critical illness. So I think there are a few changing dynamics, and it's important that I guess these are factored into the strategies of us, all of us as an industry going forward. And then reinsurance and reinsurers can play an important role. Certainly, we've been partnering with a lot of our clients to help shape up some of the future growth ambitions and power them with solutions or products that help to address the consumer needs and close the protection gaps in the market. So this is why. So when I say, you ask the question on how to optimize, I say we should strategize. It should be more of a strategic buy and a buy that reflected the ambition of both the insurer and the reinsurer. I definitely echo the statement. It's important to start early, and if you want to do something strategic, you don't do it last minute. So it needs to be thought through. And then there are some, important and good conversations that need to be had, I think, throughout this renewal. And so we're already well underway in a lot of the discussions, as I'm sure many of the attendees on the call are. So I think this would be, my thoughts. You've asked particularly, Chandra, on, capital, right? And I've kind of hinted to it. So we're here to support growth. I think reinsurance is a form of capital relief, and it supports and enables growth and allows brings more sometimes stability to the balance sheet and allow a higher capacity. And so we have, I think, predominantly, I look at our market, I look at ourselves, from a Swiss perspective. We have a very strong balance sheet. We have the capability to take over risk in appropriate risk transfer mechanisms, and support reinsurers, the insurers as their growth ambitions in India. Which for us, we're very excited about the future. I think we've had a very difficult year in 2020, but from our side, and I know from our discussion in the market, there's a lot of optimism for 2021. But really, on the long term opportunity that India presents, and for our business. And so that would be my tips, and I hope to hear from many of our clients and engage in these strategic conversations.
Yes, Sanjeev, final word.
Okay, I think just maybe 5 points, Chandra, just to round up everything. One is I don't think it's a time to do anything exotic. So stick to as a cedent, stick to your existing renewal, your expiry program, unless there's some really urgent need to change something. Secondly, I absolutely echo Ridesh's point. Please value relationships. That is what insurance is all about. However, I'll just add one more thing, that sometimes there's also a time to have your eyes and ears open, because your existing relationship may not be maybe having their own issues by which they may be constrained to reduce the capacity. So keep your options a bit open. And that goes back to the point that we've all spoken about. Start early, start as early as possible. Get those hard conversations with your broker, with your reinsurance partner, saying that will you do it or will you not do it? Don't wait for 25th of March for it to happen. I think it's a time for very authentic conversation. And I love the optimism that Hadi has. I think all of us have that optimism about India. The scope is huge. This will get over. This COVID issue will get over. We'll go back in 12 months, 18 months. We will go back to a nice soft market, and we'll look back to this and see that this was a battle won that we did. So,
yeah, thanks all of you. Now it's about another 10 minutes for question answer from the audience. I would only say only one statement, that you should not look for what the cedents are going to do for you, what you can do to the cedent. That's what the reinsurer should think. And the insurer should think what you should expect you should do to the reinsurer. So both of you together work solidly to continue to support each other. I think that's the message that is coming at this time of critical nature. And therefore, do not ask what you have done. So you better do what you are supposed to do. So over to Sanjay Bokashi for taking the question answer session. We've got another 10-15 minutes maximum, I think. Sanjay, over to you.
Yes, thank you, sir. I expected many more questions from the participants, but we don't have. I repeat my request to all the participants. Please put your questions in the chat box. The industry experts are there in front of you, from insurance community, from reinsurance community, who can give a
question from Sanjeev Chopra. Can you see that?
Yes. I will just take up that question first, because it's quite an interesting question from Mr. Sanjeev Chopra. Thanks for the question, Mr. Sanjeev. I will read out the question to the panelist. I somehow feel that this question is more for Mr. Hadi. That did risk provider think to craft wordings for current or more kind of pandemic in future? Is the risk provider ready? That is the question. So I would put this to Hadi.
Risk provider is also a application.
Yes, I will start with reinsurer and then come to insurers.
Yeah, thanks, Sanjay. I think if I look back at the lessons that we drawn from this shared episode in our history, I think there's a lot of things we can take away, and certainly a few things stick out around the need for stronger societal resilience and around the need for sustainable solutions for the future of the world. And so the word pandemic itself comes, the origins of it is from the Greek, and actually it means all people. Pan is all, and demos was, the meaning of it is all people. And so it's clear in my mind that any response to any pandemic need to be a cooperation across all levels of society. And that's really the best way to deal with any crisis of that size. I think from, the people, obviously, they want us to care, and it's important that we care about humanity in these times. And I think especially that COVID-19 has changed the outlook for many people over the course of the past year. And so I see, personally from my side, we see an opportunity for building trust in institutions, at local, at national, at supranational levels. Like I said, any response to any pandemic of that scale should be a concerted effort. Working with governments, with world agencies to be able to address all the risks that come out of it, and actually bring the resilience that needed for the people. And that has to be planned, that has to be thought through. In terms of how can the insurance or reinsurance industry help, I think there are some reinsurers that can step in to support governments in analyzing and better understanding and modeling pandemics. Certainly, as we see, we've built a model throughout the years to really understand the full economic impact of pandemics and the implications of them, and any response, right? So before we talk about any wording or any crafting any cover, we really need to understand the full implications of a pandemic, and I think it's still unraveling as we speak. And so I think the industry can facilitate this discussion. From my view, I don't think it's a risk that the industry can take, but certainly we can play an active role in supporting this concerted effort, which should be driven by, like I said, institutional organizations at local, national, and supranational levels.
Thank you.
I don't know if any of the peers have anything to add on this.
I will come to Mr. Ritesh and Mr. Sanjeev on this little later. But before that, I remember I had posed a similar question to Mr. Chandrasekharan during our last session, wherein we did discuss on similar line. There seems to be a lot of similarity of thoughts here, that there has to be a concerted effort in terms of meeting such a catastrophe which humanity had not seen for many years in the past. The pandemic losses to insurance may get restricted due to various reasons, but the fact remains that many industries get impacted adversely by the pandemic, and that is where government and insurance industry should join together. Since Mr. Chandrasekharan has also posted a comment in the chat box, I would like to request him for his comments here.
See, the question of anything which is unknown, we try to say, we say exclude it in our policy wording, creative wording. That means when we cannot measure it, it is not for the commercial insurers to take. When we do not know the impact, we do not want to be the insurer or reinsurer of the last disaster. The moment we know this is pandemic, this is affecting this way. For example, the present pandemic affected the non-material damage PM in a big way. It has affected the issue of allowing permission to enter the premises, not denied by the government. The people could not discharge a cargo. The cargo was in the ship, could not even get discharged in the and it got contaminated or spoiled. So claims have come arising out of an event which they did not expect. But however, it was unknown, like tsunami. Tsunami was unknown till 2005, and then everybody started talking tsunami. Therefore, the thing when it becomes unknown becomes known, commercial insurers and reinsurers will have to get together to price it and give a proper cover and leave the unknown to the government. This is my view, and therefore, as long as it is unknown, the God will help. If it is known, the human beings will have to get together. That's my point here. And yes, sir.
Thanks, Mr. Chandrasekharan. Coming to Mr. Ritesh, same question from insurers' perspective view. Nice to see you after so many years, Ritesh.
Yes, of course, I remember you. And, it's been a while, Sanjay ji. See, at a larger level, I don't think it is the most appropriate thing wherein we say that in an Indian marketplace we will only do things if the reinsurers impose them in our treaties. Okay, and that is why when this question comes up, I think as primarily as insurers who understand the marketplace probably much better than a reinsurer would. These are things that we really need to bring into the marketplace. And there have been developments which have happened in the past. So cyber. The sheer fact that it's. If there is something which is excluded from our treaties, but still is there as part of the core wordings that we go out and issue, then there is a problem. Yeah, because in Chandra's terms, it would be a DIC. Okay. So what is very, very important is that at the end of the day, we really need to know what is the risk that we are on, so that then we are able to honor it properly, and it is not something which falls in the crack that we think it is not covered or we think it is covered. So a difference between what the insured thinks, what the insurer thinks, and what the reinsurer thinks, and therefore earlier on we spoke in terms of contract certainty, and I think it is not only is a contract certainty between in the contract between us and the reinsurer. It's also important there is contract certainty between the piece of paper that we hand out to the insured. So I think what has happened is that there is today, in a manner of speaking, a need to actually sort of look at all the wordings that we have, because the kind of risks that we have are actually changing. There is enough literature today which seems to be suggesting that cyber, for instance, could actually be as large a risk, if not larger, than what NatCat was. And therefore, I think it's very, very important that we understand at least that what does our policy wordings cover, so that we in turn are suitably protected and give contracts to our insurers.
Can I join, please, Mr. Chandrasekhar? Mr. Sanjay? Yeah. I would like to add a point. I would like to add a point here. Yeah, okay. I fully concur with Mr. Ritesh, because it's perfectly right. The insurance company is always looking forward to support on, back-to-back basis. When they issue a policy, they promise to pay certain type of losses occasioned by certain perils, and they are looking forward to support from the reinsurer in the event of something, some loss occurring. But when a loss is reported, we find that many events or losses are not covered. Very common case is that we have a motor XL, and most of us might be surprised that it carries a lot of exclusions. One of the exclusions is about the carrier of diesel, petrol, extra hazardous materials carrying vehicles are excluded. And it is very common that India is a country where we have so many number of trucks, lorry tankers carrying diesel, other petroleum products, and they cannot be on the road without insurance. But excluding this large category of vehicles from the scope of reinsurance cover has been a surprise. So we have to discuss with the reinsurers and then convince them that large chunk of business is emanating from this source, and so they have to be covered. With the great reluctance, they got covered for some of the clients whom we are representing. So this is the area where the treaty wording has been prepared long before. Unfortunately, there has not been review of many exclusions and many coverages. So there is always a need for a review of what is covered, what is excluded, what are the different deductibles, etc. So this should also be frequently done by the reinsurers also, so that they are here to support the insuring public. Idea is that both insurers and the reinsurers have to work hand in hand, so that the society is safe.
Yes, I concur, Mr. Selvaraj, as a reinsurer, that review should be a continuous process, review of wordings, review of clauses, and it should not be induced by some catastrophe. That will be more reactionary rather than proactive response. I will now turn to Mr. Sanjeev Jha, if he would like to contribute.
Yeah, Sanjay, I think much has been said. I'll just touch on the point that you and Chandra mentioned about how when things are unknown, there's a role for society or at large, or maybe the government at large, to really step in and reduce the uncertainty. So I think an example, and I'm seeing it from outside India. I'm not seeing it from India, but I'll give you two examples where I think the industry has responded. Clearly, from outside, when I was reading about the Indian response, the COVID health insurance product that was launched across the industry with the help of IRDA, I think was a fantastic initiative. I don't know whether it's making underwriting a positive balance or not, but clearly it was a very good initiative by sponsored or promoted by the regulator. A similar initiative, I'll talk about Sri Lanka. You mentioned, Sanjay, in your talk that how economies have been rattled by this pandemic. Sri Lanka is a tourist-dependent economy. There's great beaches, beautiful people, great food. They also play some good cricket. So all good reasons to come and travel to Sri Lanka. But post pandemic, the entire tourism has been dead. Now, one way to encourage tourism is the government, again working with the insurance industry, has launched a lovely insurance product, which is part of the visa approval process, and says that if you're coming into Sri Lanka, as part of your visa, you get this COVID health product. Basically, it gives a diagnosis in case you're diagnosed, all those good things. So clearly, the government has stepped in, working with the insurance industry, and so I think these are areas where beyond the insurance industry, sometimes we may need to be prodded to some stuff. The good thing is, as Hadi mentioned, is that slowly we will start getting data. Of course, groups like GIC and Swiss Re will have much more data than small companies like us. But point is, we soon have knowledge about how to start underwriting these risks that are today unknown. And I'm extremely optimistic that in the next 12 to 18 months, we'll have solutions to many issues. May not be able to solve the diesel issue of silver ash, but I think otherwise we'll solve all the other issues that we have for COVID.
Thank you. Thank you, Sanjeev. We are actually running out of time, but still I will take another question. I'm still, we might exceed time, but let us still go for this question, because this is from Jishan. And during my earlier conversation with Jishan, I know that this question has been in his mind for some time. And his question is, should the cedant not volunteer to use COVID-19 era as an excuse to assess and realign their risk transfer or reinsurance buying strategy to bring in more underwriting discipline and create a structure that is more sustainable and creates a strong reinsurance partnership? So it's a very pertinent question, something which I would like any of the panel members would like to take.
Can I start? I mean, why do you need COVID-19 as an excuse to do something? I mean,
yes.
To me, in any case, as a company grows or as a company evolves through the years, I think every few years you need to take a pause and sort of reassess. I mean, what you need to do. I mean, at the end of the day, there are others who are relying on your risk management. And if you yourself do a bad job of your risk management, then obviously they have not insured with the right people. So Shishan, I mean, I would only say that, I mean, COVID could be used as an excuse to do that. But why COVID alone? I mean, frankly, sort of every few years, every company, I mean, whether it's an insured, sort of who do their risk management by insuring with us, or part of their risk management sort of through a risk transfer to us. I mean, an insurance company who does their own risk management in terms of what to write, what not to write, how much to retain, how much to transfer. And likewise, even I mean, to that extent, the same holds good from a reinsurer's perspective themselves. So no time is a bad time. Perhaps those who have not done this, COVID-19 can act as a wake-up call for them.
I want to say only one point.
Please,
The
sir.
difference between a social insurance or insurance for the purpose of society and an insurance for working on commercial premises. When you look at these two things, the commercial insurer would like to get out of the losses, or he will make some profit at least over a period of 5 years. And therefore, he has to have a reinsurance buying strategy, more, less, bargain, and so on and so forth. Whereas for a person with a social insurance, where he has to necessarily give the insurance, whether there's a loss or whether he reaches recovery or not, he is not bothered. And therefore, you need to distinguish between a market which is more towards social insurance or moving towards a commercial insurance. So the commercial insurance concept has to make the insurance company sustain, and therefore they have to change their buying strategy, buy more or buy less, bargain cheaper, try to adjust the premium, and finally ensure that they survive to continue to serve the policyholder. So that's the only point I wanted to do.
Thank you. Thank you so much. I think we are almost running out of time. So let us conclude the question answer session at this stage. And I would like Mr. Masood Wahab to take over so that we can conclude with summary by Mr. Selvaraj.
Yeah, thank you. Thank you, Mr. Sanjay Mukashi. Thank you very much. I know one or two questions are still there, but then looking at the time constraint, maybe these questions will be saving and we can respond to them, through a mail or something. But right now we'll go over to the last part of the program. And for that, we have with us Mr. Selvaraj, who is Fellow of Insurance Institute of India. And he started with his career in Corporation Bank. And he joined General Insurance Corporation of India as officer in 1978. And then from there, he came to Oriental Insurance Company, where he worked in various positions of responsibility, including heading its marine, aviation, and energy departments. And now he's with Shriram Group, Chennai, as Director Reinsurance in Bharat Re Insurance Brokers Private Limited. He has a live relationship with insurance companies in Colombo, Sri Lanka, Nepal, Bhutan, Philippines, Vietnam, Malaysia, and Singapore. He's also a visiting faculty on insurance and reinsurance. I'll request him to kindly conclude the session, give his own points and suggestions as far as this webinar is concerned. And one thing just to add to it is that one point which has very clearly come out is the wording issue. And in India, we have been using some of those very old wordings. The time when I joined the industry, the same wordings continue even today. So over to you, Mr. Selvaraj.
Thank you, Mr. Wahab. Yeah. Distinguished speakers, panelists, and participants of this webinar. I am very glad to be part of this evening today. We are at the end of the session, so I will not take much of your time. Regarding, the revision of the wording, I would like to narrate, a few, experiences very, very briefly. Yes, okay. All the treaties carry a sort of an exclusion of mining works. Most of the fire treaties, okay. And this exclusion has been there for a very, very long time. We had an occasion, to deal with a mining risk reference. It's sort of a open mining as well. And when we refer to a reinsurer in our Indian market, they turned it down. Reason is that, they would not like to cover. Then we have to ask them, do we have any sort of experience? It's an exclusion, right? Do we have any data for covering these mines? And having covered it in the past, whether the loss has been so adverse, do you have any data? No data. Then have you ever issued any policies? We are not aware of having issued any policies. Then how do we conclude that this class of business is bad per se? And then we left it, then we went to some other reinsurer in South Africa. And there you see the reinsurers are little more familiar with this mining risk. And they were able to say come out with a very wonderful lead terms. And with the lead terms, we approached the Indian reinsurer. After looking at, you see, they initially committed a follow line. Then after a couple of days, wouldn't you give the lead role to
Does he have network issues?
I don't know.
Looks like
You were saying something about power.
power. Could be power also.
Power has gone out. Oh no, he's back.
Yes,
Yeah.
Sorry, friends, yes, there is a frequent power cut you see in our part of the land. So obviously, this is coming and going. I'm glad that I could, resume my connections with you. I hope I am audible to all of you.
Yes.
Yes.
Okay. So after we produced a lead term, then the Indian reinsurer was willing to even take over the lead role also. So this is once again to prove the point that you see, we are not in the habit of, reading our own policy wordings or treaty wordings, and then we see carry out the test whether all the exclusions are relevant as on date. All the coverage is also very relevant as on date. So staying relevant, you see, is very, very important these days. This is point number one. And then point number two, it was very interesting to listen to what happened in African market and then Russian market and then Sri Lankan market also to some extent. I had the privilege of dealing with Sri Lankan market January renewal as well as Philippine market January renewal. And our experience has been that you see the response from the reinsurer was a bit disappointing from the client's perspective, because in the last 2 years there were not so many losses also. Treaty experience was very, very favorable, but in spite of it, you see, the capacity was reduced. Then for say another insurance company, the Philippine market, the XL rate, you see, almost doubled in spite of the last 2 years proven to be claim free years. Okay, so the reinsurance market seems to be very hard in the reinsurers who are dealing with the Philippine risk. And it was really very, from the perspective of an insurance company, it is very, very difficult to bear it because they have to live and work, you see, in a very, very competitive environment. The primary market is very soft, and you see, relationship counts a lot in the primary market. You see, the relationship and the business matter a lot, both the insurers and reinsurers. In the case of the insurance company, the relationship matters to a very great extent. Okay? Whereas for the reinsurers, numbers matters to a very great extent. And you see, reinsurers evaluate everything in terms of the numbers only. And it so happens that you see there are sometimes gaps. Either due to some very bad event or due to some other reasons also. So reinsurers are throwing up their hands, not recognizing that that is a time when they have to come to the rescue of the insurance company and then help them out and then try to solve the situation. Yes, but that was not witnessed to see the case of renewals where my clients are concerned in Sri Lankan and Philippine market. This is point number one. And then point number two, the pandemic, you see, did not affect, you see, the business volume as far as Sri Lanka is concerned to a very great extent. I have the figures with me. For the year 2019, the entire market business was 553 million US dollars. For the year 2020, the figures just released, they read 546 million US dollars. So there is a gap of only $7 million. That's a gap. See, the non-motor business has virtually registered an increase by 3%. Should have been much more than 3% in the regular time, but this was rather restricted only 3%. In the motor segment, you see, we witnessed a sharp decline in the Sri Lankan market, and the motor volume declined by 3%. Otherwise, there was not that much of any, significant, you see, a drop in the volume of business. Then you see, coming to the reinsurers, I would only, reiterate here that reinsurers play a very crucial role as far as the repaying the losses to the insurance companies are concerned. We had to see the EQ event in Nepal market in 2015, and most of the companies were saddled with the losses much more than they receive capital plus reserves. So that was a time when all the reinsurers, they joined hands, they bailed out the insurance industry in the Nepal market. And then same way in the Indian market also, every year we have been witnessing major events, major cat events resulting in very huge size of losses, and the reinsurers are with us. But I really wonder whether we are giving the reinsurer their due. They become sort of heroes unsung. And even in many meetings also, we solicit their support. And I really wonder whether we really sing their praise, at least to some extent. I would like to pay my compliments to them for having been part of all these markets, Sri Lanka, Nepal, India, all the markets, and then bailing the insurance industry out. And I look, on behalf of all the insurance companies in these markets, I would like to, request them to continue their excellent support. And the Indian market also, we are going to witness the renewals now in the month of April. And all the insurance companies have already commenced their preliminary work. And I am sure, a lot of activities are going to be witnessed. And I believe that the reinsurers will be with the insurance market. I will appeal to them not to reduce the capacity unnecessarily. Indian market has undergone a lot of changes, a lot of quality changes have been carried out due to the instructions for charging minimum rate for the property risk. So the results will be improving, definitely improving in the long run. I would rather appeal to the reinsurers to ensure that they continue and extend their support for the Indian renewals. And as far as this AIIRM is concerned, they recently set up a unit, and this is totally dedicated to promoting insurance, education, training, etc. And they have come out with a wonderful training program. Recently, I think they had a training program on arbitration, and they will be commencing training on all the subject in insurance as well as reinsurance. We have, very seasoned faculties. The yesteryear heroes of the insurance industry are the leading lights of the AIRM. They come here with a lot of experiences, a lot of knowledge, and the participants will stand to gain a lot, both in terms of experience as well as expertise. So I will appeal to all the participants to take advantage of the training courses offered by this institute, and they would also recommend to their personal department, training department, to nominate people for undergoing training in this institute, so that they really love their work, and the life of the insurers are brighter tomorrow with better education and enlightenment. Thank you, friends.
Thank you, Mr. Silvaraj. I'd like to thank all the participants. I'd like to thank all the speakers, all the panelists.